Last week, we collectively, as a retail shareholder base, posed a ton of difficult questions to SoFi management. And earlier today, on the Bank of America Fireside Chat, the CEO himself, Anthony Noto, answered all of those questions. He talked about the growth in the technology platform. He talked about the vision going forward for the business. He talked about how they make difficult decisions internally with regards to new product launches. And not only that, but he gave us a sneak peek at a massive new product offering that has the potential to totally change how we think about SoFi's total addressable market. I'm going to break it all down in this video, and there's a lot to cover, so let's jump right in. Okay, so before I get to the actual fireside and play some of the clips from the fireside, I wanted to lay the groundwork for what led up to this event. As you know, last week there was criticism from the retail investor community, myself included, that there was a lack of communication from management overall. Anthony Noto, the CEO, responded saying that they are paying attention. I also made a video around specific questions that we on the SoFi Weekly would ask management, and on the fireside chat, they addressed many of those concerns. And to some degree, it shows that they're in tune with the retail shareholder base because the questions that they answered were nearly identical to the questions that we asked online. So, at the very highest level, we can say that management is accounting for the retail shareholder and they are listening to retail shareholder concerns around their communication. And as I go through this video, I want to go chronologically and I want to also play clips from the actual fireside so you can hear not only my words, but directly from the CEO, Anthony Noto himself. The fireside started off with some big vision questions, and immediately one of the things that the host let slip was the number of members that the company was tracking to, saying that they were tracking towards 14 million members. I didn't catch this, but Tanner did. He asked the question whether this was an internal target that we're not made privy to, because in their Q4 earnings presentation, SoFi shared the minimum threshold for member growth being 2.8 million. So to have 4 million member addition could be an internal target, but this is likely nothing, and the host probably misspoke. I'm not really reading into this. I mean, he said 14 million, so I feel like I should bring it up. Off the bat, Anthony Noto referred to SoFi as a mission-driven digital financial services company. As I was live tweeting this, I actually forgot the word digital in there and he responded correcting me. This is intentional because of the role Galileo plays in powering SoFi, which we're going to get into in this video itself. He said, we have a bank, but we are not a bank. So that cleared up the age-old question of what is SoFi. And he mentioned that one thing that is a differentiating factor for them is that they have this technology-first approach, which allows them to have lower operating costs, higher scale, have more user data that leads to more personalization in their product offerings, and allows them to move at higher speeds due to them just being technologically focused at their core. He said, we have no branches, we have no humans. A lot of it is unlocked through technology, and there's operating leverage in doing it that way.
People think the tech platform's success or failure will determine whether SoFi is a fintech company or a bank. Let's be perfectly clear. We're a mission-driven digital financial services company. You can't be digital without technology. We don't have people taking orders or giving out cash. Machines are doing that for us. So the tech platform at the end of the day will serve SoFi in a great way, and in doing so will be a great business to other people. We have a bank, but we're not a bank. That bank serves us well in allowing us to use low-cost deposits to fund loans. That's its purpose. But at the end of the day, that bank also allows us to do B2B activity and be the sponsor bank for Galileo and the tech platform in building these other businesses.
He talked about SoFi's growth in 2025, and he also reiterated the confidence around 2026 guidance of 55 to 80 cents in EPS and how they're going to drive 20 to 30% return on equity as the business continues to scale, which is great because that's exactly what we want to hear. We want to hear him repeatedly reinforce these numbers around these growth rates because analysts right now are sandbagging those same targets for 2026.
But we believe the opportunities for growth are so significant that we just raised our 2003 2026 revenue CAGR to more than 25%. In addition to that, we have more confidence than ever in our 2026 EPS guidance of 55 to 80 cents per share. And in addition to that, from a return profile standpoint, we believe we can drive 20 to 30% return on equity as the business continues to scale and matures.
He talked about 2024 and how the priorities back then were different and how they were focusing on profitability, and how now in 2025, they're going to be reinvesting back into growth across all their product areas, but being cognizant of how they're essentially allocating spend, because he said they can grow faster if they wanted to, but doing so would steal growth from future years. And so they want to maintain it at this level because at this level, they can stay at a consistent level of growth for the foreseeable future.
It cannot be overstated how much we're investing in our current products. We're going to continue to invest significantly in improving the Invest product. We want the selection with Invest to continue to increase. We want the ease of use to continue to increase. And we want to help make our members investing seamless across products and services. We'll also increase the awareness of the Invest product. In 2024, about 70% of the Invest member growth came from existing members. We have an opportunity to increase the awareness of that product outside of SoFi, and we'll do that as well. Our cost of growth has not gone up, but our opportunities to invest more in growth have. We'll also invest more in SMB lead generation, as well as our Protect business. In addition to that, we're investing meaningfully in the Galileo technology platform to serve a broader set of SoFi's needs across our SoFi Money products and other areas. And so those are the major areas of investment. We could have much, much higher incremental margins than 30%, but we would starve the growth of the company in 2027 and 2028. And we're committed to driving 25% EPS growth or higher beyond 2026. Someday, I hope we spend nothing on marketing and our products are all driven by word of mouth because they're so damn good.
He talked a little bit about the diversification of SoFi's businesses and the revenue streams. He was talking quite a bit about the fee-based revenue model and how that can command a different multiple because of how diversified that business is relative to having 90% plus in lending, which is what they had back in like 2018. Now, the fee-based revenue streams are growing significantly faster than the lending portion. They require little capital. They have a low risk. And he said you can expect our fee-based revenue to increase well over 50% of our total revenue.
Different revenue streams get different valuation multiples, and that's because they have different returns. And the fact of the matter is that the fee-based revenues are non-lending. They are higher multiple businesses because they require less capital. They're less risky, and they're dependent on less variables to drive success. And we wanted to show that how we were diversifying the business, making it less capital intensive to drive growth, making it less risky, and reducing the exposure to the credit markets. When I got to SoFi, more than 95% of the revenue was lending. So it's really rewarding at the end of 2024 for it to be about 50-50. The second thing we emphasized and started to disclose was our fee-based revenue. Fee-based revenue for the year totaled $970 million. It grew over 75% and will continue to grow faster than the rest of our business. So as the business is incrementally becoming less capital intensive, less exposed to credit risk, more visible and more sustainable with higher ROE businesses. And we'll continue to focus on that. You can expect that our fee-based businesses and revenue continues to increase well over 50% of our total revenue. And those revenue streams are things like interchange on credit card, interchange on debit card, the lead generation we get from our SMB products, as well as our insurance products, home, auto, and life, in addition to our loan platform business, the technology platform business. These are revenue streams that are largely cash. They're upfront, require very little capital, and have very low risk.
And then the host drilled down in the technology platform with a question taken straight out of my video around whether the way that they're thinking about the technology platform has changed given the growth rate that they're seeing within that segment. Roy also talked about this in a recent post when he broke down the actual mentions of the technology platform on earnings calls going back 5 years. And it was really great to see this question being asked because it's top of mind for everybody in the retail investment community who saw the Q4 results and who saw the growth rate of the technology platform not being as high as we had collectively hoped for.
And it's not just big banks and fintech companies, it's government organizations, it's B2B companies, big consumer brands that want to be in the financial services industry. Have we grown it as fast as we would like to? Absolutely not. It's obvious. The world went through a tremendous change. After we bought Technisys, we saw the demise of 3 large banks in the US, a lot of focus on regulatory issues. Companies weren't ready to transition their technology. That happened at the exact same time. We had moved our focus away from fintech companies because we didn't see them as durable customers with durable revenue. But we're in a great position to capture a big part of the large banks and financial institutions. That hasn't changed. We're still in the running for some of these big deals. They're taking longer to be decided than originally planned. But the strategic importance could not be greater and the benefits could not be greater. And I think it's a huge differentiator for us.
Anthony Noto did reiterate the importance of the technology platform and how it plays a role in SoFi's growth story as a whole, regardless of the third-party businesses that they provide the technology platform to. That the technology platform in isolation helps them scale, helps them with regards to speed to market, helps them with regards to cost savings, with regards to efficiency improvements, and overall vertical integration that serves the mission for the end user that SoFi is trying to achieve. SoFi as a business would not be able to achieve this mission if it were not for the technology platform to support that. What Anthony Noto is saying, at least how I interpreted it, is that you should be thinking about the technology platform twofold. The primary function of the technology platform is to power the rest of SoFi's business, to unlock all of these efficiency improvements, to essentially help them as a business internally move faster and roll things out more efficiently, and eventually have more trickle onto the bottom line because they're doing all of this stuff with increased operating leverage. The secondary benefit of the technology platform is to provide the same increased experience to third parties, which is that entire AWS a fintech narrative that we collectively have been talking about. But I think with regards to the technology platform, it needs to be said because sometimes the quality and the efficiency of SoFi's own product lines is taken for granted, where investors just assume that more and more members are going to join the platform and that members are going to keep growing in that ecosystem. But a lot of these unlocks are as a result of the technology platform powering that backend. Because if there was not a good experience from a user perspective, ultimately those members would not grow at the same speed. They will not adopt it at the same speed. You wouldn't have all of this word of mouth expansion into that flywheel. And so it needs to be said that the technology platform, even if it did zero sales to any third parties, would still add significant benefit to SoFi internally. Is that the technology platform still fits into the vision because of what they unlock for SoFi as an entity.
The strategic importance of the technology platform business is as important as it ever has been. I couldn't be happier that we bought the business. That business is meant to first serve the consumer needs. We learned from our lending business that if we own the technology end to end, we can differentiate much greater at a lower cost. We could personalize, we could test, and we control our own destiny. Our speed to market's faster, incremental costs are lower, the incremental benefit from data is higher, and we wanted to replicate that ownership end to end in our other businesses. It's had a big impact on SoFi directly. That impact will be even greater at the end of 2025 as we're accelerating the shift of some of the SoFi activity onto the technology platform. So SoFi is a customer of that technology platform. Third parties will benefit from all the investment that we're making in the tech platform. Like at the end of the day, our mission is the same. It is focused on a consumer and helping them achieve financial independence. But for us to deliver to them that value, to make our products better than anyone else, we need to own the technology, and we do.
And I think this entire segment of questions was stuff that I asked in that video previously, where if you could go back and replay it, I'm basically asking, why is there no growth in the tech platform? How should we refer to SoFi right now? How does the vision for the tech platform change overall? And so I was really pleased to hear that he addressed all of these points very directly. And to me, that was a clear signal that he's listening to the retail investment community and he's addressing these exact points. Then the conversation moved from the tech platform to the loan business, which I've highlighted in multiple videos as the most exciting part, in my opinion, of SoFi's growth story, especially in 2025. And I think it will continue to be the predominant topic of conversation, even beyond 2025 and future years as well, because of the vision there around how they want to evolve this business. The host basically asked around the loan platform business what we can expect in terms of growth, as well as how would it work from a credit box perspective. And Anthony Noto gave us a response that we haven't heard from before, which is that SoFi's own credit box is not going to change. They're not going to change anything about how they're originating their own loans on behalf of SoFi in terms of what they're putting on their own balance sheet. All of that is going to stay the same. They're not really chasing different credit boxes. It's entirely up to the third party that they're working with to determine what credit box they want for these loans to go through the loan platform business.
The loan platform business is very different. It's a contractual obligation that we're underwriting on their behalf. We would not otherwise underwrite those loans, and they're transferred on a daily or weekly basis, not after months of being on our balance sheet. And it's just a straight fee under the conditions that we deliver what we said that they wanted. We start the beginning of each quarter knowing how much originations we're going to do and what revenue we're going to do. SoFi's balance sheet will only be used for our credit box. We're not changing that credit box. The loan platform business, it's 100% dependent on what they want. So if they want 650 to 800, we can underwrite 650 to 800. If they want 600 to 800, we could do that as well. It really comes down to what they want, because we have no intention of putting that on our balance sheet. We're only originating it on their behalf. So it's really up to them to decide.
So he reiterated once more that this is a capital light, very risk-free way to ramp up that business. It's all fee-based revenue. And I think this is the main reason why it's going to grow so quickly. Because what we're seeing right now is we're seeing all of that fee-based revenue grow significantly faster than the other business segments. Moving on, I think the most exciting part of this fireside was when he was talking about personal loans as it relates to the credit card market. So he first started talking about when they were going out to find new third parties for the loan platform business, they realized that a massive market they can go after is credit cards, because that's over $1 trillion TAM.
So in the process of looking for other second look partners, we started to find partners that we could do this loan platform business with instead of doing second look partners. So there's a huge market. And I think one of the biggest misperceptions is that when people calculate our market share in personal loans, in the numerator, they put our origination. In the denominator, they put prime US personal loan market. That's not the market. The market is prime credit cards, which is over $1 trillion. And the reason why it's credit cards is two reasons. One, 80 to 90% of our PLs are already currently consolidating credit card debt. But the personal loans that we're extending to them are interest in an amortization of the principal. The best credit card customers, not SoFi's, industry-wide, are revolving customers. And most revolving customers are drawing down, let's say, $5,000 on a $10,000 credit card line. That $5,000 isn't being paid down. They're paying the minimum monthly payment. It's almost like subscription debt where they're paying the minimum payment and they have no intention of paying down the $5,000. But they pay the minimum payment because they may need the other $5,000 that's not drawn. And it goes on for year after year. There's a large portion of those people that are not taking a personal loan out with us at a lower interest rate, even though they're paying 25 or 30%. They could probably get a loan with us at about 13%. They're not taking out that loan because we amortize down the principal, and that may result in a payment that's equal to what they're already paying on just interest only. There's a world in which we could offer personal loan that's interest only for 5 or 10 years, but at an interest rate that's half of what they're currently paying, which means their payment would be half. Now, the benefit to them is they have an outlay of half of what they used to have. The savings they have, they could actually pay down the principal because we have no prepayment penalty. They could invest that money at a good return. They could use it for other needs. And additionally, if rates go down, they can also refinance. We don't charge origination fees unless you choose them, and we have no prepayment penalty. And so we believe the denominator is credit card debt, and we will continue to evolve our personal loan product to disrupt the credit card industry.
So I really want to explain this concept in a simple way. So he basically mentioned that over 80% of the current personal loans that SoFi offers is consolidating credit card debt. So in other words, people are taking out a personal loan from SoFi to pay off their credit card debt to arbitrage that interest rate difference. So that instead of paying the credit card off every month, they just pay off the personal loan every month, and the difference is a much smaller interest rate because a credit card is going to charge me like 25% to 30%, whereas a SoFi personal loan will charge me 13%. And so consolidating credit card debt is a really popular reason people take out personal loans at SoFi currently. Now, there's a ton of people, they realized, who just pay off the minimum balance on their credit card. They're not even taking out personal loans. And the reason why they're not taking out personal loans is because the amount that they would have to pay back is basically more than what the minimum payment is for the credit card itself. And so essentially, they don't want to refinance if it's going to cost them more every single month if all they're doing is paying off the interest. Now, what Anthony Noto was saying for this new product offering is that they can change the terms to offer an interest-only personal loan. So basically, you can take out a personal loan in order to consolidate your credit card debt, and SoFi will make it so that for the first 5 to 10 years, all you have to pay back is the interest on that personal loan. This is a way of making the monthly payment lower because the interest rate automatically drops from 25% from the credit card company to 13% from SoFi's personal loan. But by doing this, all you're doing is you're still paying off the interest, but it's at a lower interest rate. And what that does is it lowers the monthly payment. So because I'm paying off 25% interest rate every month, I might be paying, I don't know, $200, let's say. But if I have the same amount of money with a personal loan, I might be paying $100. And that's a really cool concept because all of a sudden you can imagine this massive market for personal loans where they start to disrupt and cannibalize business from credit card providers because it just makes sense from a math perspective why I would want to pay less to SoFi versus more to the credit card company if all I'm doing currently is only paying off the interest at the credit card company. So at face value, you can imagine the benefit of this simply being that the end user has a lower monthly payment. But if you dive into it a little deeper, it actually provides more flexibility for that end user to pay down the principal because all of a sudden, let's just say in that example, I have a $20,000 debt at a credit card company and I'm paying $250 a month, just interest every single month. All of a sudden, I make this deal with SoFi where the interest is $125. It's slashed by 50%. The remaining $125, I can just pay that same amount, and $125 is interest, $125 is going to pay down the principal. And so in this example, I still end up paying off the same amount every month, but I'm also paying down my principal as opposed to just paying off the interest. But even if I just wanted to pay off the interest in the first place and didn't want to touch the principal at all, the fact of the matter is that this offering will allow you the flexibility to structure it in a certain way that allows the end user to pay down the interest for a certain amount of time. And I think think that's a genius product offering. And of course, it's something that doesn't exist yet in the SoFi ecosystem. I also think that by mentioning this on the fireside chat, that this product offering is closer to launch than we think, because otherwise, why would he mention this if this is like, 2026, 2027 planned? I think this is something that's going to be launched in 2025. That credit card market is a large market, and I think this is something that a lot of people would be excited to try out. And internally, I'm sure they've had plenty of conversations around how this would work and whether it makes sense for them, and have already started down the path of launching this out. I also think there's going to be some cool benefits with regards to Cash Coach and SoFi Plus, because I can imagine a world where if I'm already paying $250 a month and SoFi has this promotion where if I refinance with them and take out a personal loan and consolidate my credit card debt, I still only pay a maximum of $250, but a portion of that goes into an investment account or some other benefit, or to pay off the principal, or I get other benefits within the SoFi Plus ecosystem as a whole. Or I can just pay half of that total amount by paying off only the interest and still get some of the benefits of SoFi Plus in their ecosystem. So there's a lot of combinations that you can do with it, and it's really going to be interesting to see how this is adopted after this is launched. But I'm going to go out on a limb and say this is going to be a 2025 initiative and not later on, because why would they mention this initiative if it's like 2027, right?
Just so we're clear, that product is not yet in market, or it's already the interest only.
The product is not in market,
Right.
but that product will come to market.
Okay. Yeah.
We could structure in a way that it's interest only for a period of time, then it amortizes down. The interesting thing is it'd be amortizing down and the payment would be equal to what they were paying before, because interest rates at 12 or 13% instead of 25 to 30%. But as I mentioned, if you give somebody a lower monthly payment of half of what it used to be, and they can choose to pay down the principal payment, they will likely choose to pay down the principal payment when they can and when they have the extra money. But similarly, they have more of a cushion as it relates to their overall budget. Again, our whole goal is to help people spend less than they make so they can invest the rest.
Finally, they talked about financial services, and Anthony Noto said that they believe that they can grow their members and their products 25 to 30% for the foreseeable future. Their target for this year is 28%, but again, I think this is going to be much, much higher for member growth. In addition to that, revenue per member is also going to increase, and that bodes well for the flywheel, because you're going to have users leveraging that ecosystem more. And so not only are members and products increasing, but also the revenue that they make for those members is also going to increase simultaneously, which are going to compound on each other, and you're going to get some real benefits from that.
Financial services. How high can that go? Is there a target you're working towards?
We think we can grow our members and products in the 25 to 30% range for the foreseeable future. I think this year we have 28% as our target that we share with the street. Revenue per product will continue to go up. So think about the growth drivers of the company, the durable growth that we're trying to drive. Think of it as member growth and product growth, 25 to 30% over the foreseeable future. Then growth on top of that from revenue per product going up. In addition to that, we're going to continue to grow the number of accounts that we have at Galileo, and revenue per account there has been declining, and we expect that to stabilize here in 2026. The reason why there's so much upside in revenue per product within financial services, the loan platform business goes into that business. We've under monetized the invest business. Our return on assets is much lower than industry averages. We're adding some products that do have revenues with them and additional fees. We continue to grow the SMB business quite nicely. It's very profitable. I'd love to invest even more money there. Protect also. And so those are all fee-based businesses. In addition to that, we have new products and services that we'll continue to introduce. The one I'm very excited about is SoFi Plus.
Yep.
At $9.99, you get all these great benefits. That's also going to contribute to revenue per product.
He said they're continuing to invest in the SMB business, and that's been very profitable for them. And he wants to continue to invest more into fee-based businesses in general due to the same benefits that we listed prior in this video. And so you can see this very clear path of growth that they've laid out. And if you read between the lines, it's something that I think they're really, really looking to double down into. This path of fee-based revenue that's low risk, low capital requirements, high return on equity, and it's growing incredibly fast relative to their other businesses. He touched on SoFi Plus and some of the benefits that it provides. And, with this, there's an ecosystem benefit in general, because he compared it to Amazon Prime, saying that the Amazon Prime membership would not have carried as much value as it currently does if Amazon didn't have such a wide selection of offerings. Similarly, SoFi wants to expand their selection of benefits and offerings so as to increase the value of their subscription revenue, which is coming through SoFi Plus. And this was top of mind since this was launched today, and there's a whole list of benefits. And so we're going to see how the take rate is for SoFi Plus and what the initial adoption is going to look like over the next coming quarters. But there's definitely parts of this talk that I think were geared towards SoFi Plus with regards to that wider ecosystem vision in general and how all of these pieces play together. And I'll remind you that this was the heart of my thesis for SoFi of what I thought the moat was for this business is essentially that hub and spoke model, that ecosystem where SoFi Plus is at the center, and all around it, you have all of these other business lines. And once you get a member into that ecosystem, they're going to cross sell and the revenue per member is going to increase like crazy because you now have an aggregate benefit of being a part of that ecosystem in general. And once you have that central component of SoFi Plus and the benefits that they provide, whether this is events or cross selling or new product offerings or an entire selection of different benefits, then I think you can launch new product lines in a very quick succession to build on that benefit and make the value of that subscription even more valuable.
We've just announced today the launch of SoFi Plus. Super excited about SoFi Plus. It's a subscription product for $9.99, gives you more than $1,000 of value a year. When you say SoFi Plus, it's a telegraphic way to say we are a one-stop shop. And then we provide benefits, not just on a credit card and boosting the rewards up to 3.3%, and not just on reward points generally, but discounts on loans, the ability to get unique access to events, one-to-one dedicated certified financial planners. One, you have to have all those products. Two, you have to have technology that allows you to stitch them all together in this subscription-based product. And we will continue to add more and more value into the SoFi Plus product.
And he finally concluded the 40-minute conversation being asked around the stock price, saying analysts were misguided if they think that SoFi is at risk with regards to capital ratios or that they need to raise more money. He sort of banged the table a little bit and called some analysts out, saying that they can't read a balance sheet if this is what their argument is, which is absolutely great because you have some of these analysts who still maintain super low, unrealistic price targets for SoFi. And it's very transparent at this point because their arguments are clearly regurgitated and can be debunked very quickly. And finally, as a little treat, he talked about level one options, which we in the community have been asking for a long time, simply to say that they consistently make trade-offs around what they want to launch and what has the biggest impact with regards to their roadmap. He compared level one options with something like SoFi Plus, which they just launched, saying that SoFi Plus helps the entire ecosystem and level one options is something that's more beneficial to a smaller group. And in fact, level one options is even more beneficial once you really do have SoFi Plus. So it is a trade-off between what they launch and what has the biggest impact to move the needle with regards to their business. So that's how you have to think about their future launches. Overall, I think the call was terrific. I think they tackled a lot of questions that I had. I mean, if you look at the video that I made last week and the question that the analyst asked in the Bank of America fireside chat, I wouldn't be surprised if he took all of those questions from that video, from the technology platform questions to the loan platform business, to the thought process around how they're thinking about new releases, to the vision around some product offerings by explaining how SoFi Plus would play into that ecosystem. I mean, he reiterated the growth numbers consistently. I think that fee-based strategy is definitely the way to go. I think that's going to pay dividends on the road. I think it's going to be reflective in their financials as they continue to scale this year. So not only did he highlight all of these questions, but he also went one step further into sharing this interest-only personal loan product offering, which is coming shortly and has the potential, I think, to change the entire landscape around how people think about credit and credit cards in general and what the total addressable market is for SoFi. Overall, he sounded fairly confident, as you can tell from the clips that I just played, and I think it was very well received by the entire retail community because there's more transparency and more communication is obviously welcomed by this community. I hope you enjoyed this breakdown. I know it went a little bit long. And if you saw this talk live, let me know what you thought were your favorite takeaways. I'm going to do a full SoFi news recap at the end of the week, but this event definitely warranted its own video. Thank you so much for watching. I hope you enjoyed it. I hope this was valuable for you. If it was, subscribe to the channel and share this video out, and I'll see you in the next one.